Welcome, everyone. Thanks for tuning in. I'm your host, Megan Henrik. Here's a question for everyone in the audience. Would you say you're an above average investor? Most of us would probably assume that we are, but a closer look might suggest otherwise. For example, take a study by researchers at the University of British Columbia's Sauder School of Business last year. It found that investors who actively traded stocks experienced almost 50% higher volatility in their portfolios than buy and hold investors did over 20 years. Plus, they often earned lower returns too. These active traders likely thought they were protecting their portfolios from risk, but wound up achieving the exact opposite. This is just one of the many common mistakes that investors tend to make that may sabotage their returns. And some of them can be traced back to biases and blind spots we have in the way we think. In this webinar, we're going to address them so you can hopefully avoid making those same errors. Here to help us is Charles Edgar Martin, Senior Investment Advisor and Senior Portfolio Manager at TD Wealth Private Investment Advice. He has more than 20 years of experience in investment management. So naturally, he's seen plenty of fumbles by investors over the years. He's going to share some of those common pitfalls, what might cause them, and what you can do about them. Charles, thanks so much for joining us. Great to have you with us.
You're welcome, Megan. Nice to be here.
So, investors are often their own worst enemy when it comes to managing their portfolios. Why do they consistently make decisions that can hurt their returns?
Well, I think you have to realize, first of all, that we're emotional creatures, right? And, some people like myself, I tend to think of myself as more logically, more logic than emotional, but I think we really are more emotional and we are logical. And that, it gets in the way of making investment decisions, good investment decisions. I'd say most often good investment decisions are based on logic. So there you've got that internal conflict where we're mostly emotional and we should be using logic, that can cause a problem. So there's actually, there's a school of thought called behavioral finance, which has pointed some of the cognitive biases that we have that get in the way in investing. And, a couple of them are overconfidence in our investment skills. Like you mentioned, if most people think they're above average investors, it's kind of like most people think they're above average drivers, right? But that's not logical, right? We should, on average, be average. But we are overconfident in our investment skills in general. There's also anchoring, where we kind of we keep certain prices in mind, and we can't forget those prices, and they get in the way of making good decisions. Another one is loss aversion. We tend to not look at things logically when we're in a loss position, or the fear of regret. If all your friends are doing something and you're not in there, you start fearing that you might be the only one who doesn't get it. And those things really don't have very much to do with making good investment decisions. However, I think most of us can relate to some of those things, and I think a lot of it also has to do with fear and greed. Um, so there have been periods where we felt like overly fearful, perhaps in the beginning of the pandemic, or overly, or as Greenspan said, irrational exuberance in the late '90s, where the internet was coming and we could only see good things, and that difference between fear and greed also gets in the way of good decision making.
I think that's really helpful for our audience to know that, like, throughout time, there's this tug between that emotion and logic that can kind of hinder our decision making abilities. So, in your experience, how often are investors able to stop themselves from repeating the same irrational mistakes once they've recognized this behavior?
Well, I think like any problem, recognizing that you're doing something wrong is the first step. It is extremely difficult to act logically when we're looking at our own investments. So I think one of the solutions is to use an outside advisor, people like myself, And that can be helpful for some people. Those that try to do it on their own, like I said, start by being aware that what you're doing and how your emotions are getting in the way. And I think you have to think about things like, um, I hear this often, and I'll go back to March 2020, beginning of the pandemic. Is all we most of us remember. It's not very long ago. The market had declined quite a bit, and as an advisor, what I will receive, the kind of comment I will receive a lot of time is, you know, I hear what you're saying, Charles, that things will get back, but I'm a little bit too nervous, and I think we should sell out all our risky positions, all our equities, while there's so much uncertainty. And when things stable off, as you say they will, then we'll get back in. Now, I think if you ever hear yourself saying that kind of thing, I'm going to sell now while there's uncertainty and come back in when things are a little bit more stable. Ask yourself, if you're selling when there's uncertainty and buying back when people are more confident and things are more stable, are you not selling low to buy back high? The chances are that you are, because if you're selling an uncertainty, you're selling when there's a lot of pessimism, and you're buying when people are more optimistic. That's not a winning formula. And this is, I'd say, one of the most common mistakes that investors make, and it can really ruin several years of good work. If you look at last market correction, for example, or bear market, I should say, that was the one that was associated with the pandemic. I think the S&P 500 from top to bottom was down something like 36%. So if you made that sale somewhere around minus 36% and you bought back when you're feeling a little bit more comfortable, let's say a year later, I mean, I don't have the statistics in front of me, but you probably wiped out several years of work. So you have to be aware of those things. Really let the emotions make the emotions out of your decision making process. Use your logic. And you know, when I started in the business, an old timer who was trying to mentor me, and he was a good mentor actually, said the four most dangerous words in investing are "it's different this time." So whenever you hear yourself saying it's different this time, remember that you're probably about to make a very big mistake.
Investors have access to more financial media content than ever before. How might our media consumption reinforce some of the cognitive biases that we often exhibit?
I think there's a real negative bias in the news, and that also clouds our judgment when we're making investment decisions. So you have to be aware of that, I believe. I'll never forget in January 2015, there was an article that I received by I think three or four clients sent it to me one morning, and I was on the phone with one who'd emailed me this article and called me, and the person was really nervous, and the headline went something like this. It was like the chief strategist of one of the top 50 banks in the world is predicting a recession really soon and is recommending that all the clients in the bank sell their stock positions before, this huge drop occurs. So you can see why a lot of people would be nervous about that. But having the training I have and trying to look at news with a little bit of a different point of view, before even reading the article, I said, let me rephrase that headline without having read the article. And I'm pretty sure I'm going to have, like, I'll be describing what's actually in the article. Just the headline will be a little bit less nerve wracking. And I said something like 49 of the 50 top bank strategists, or 98% of the strategists of the top banks in the world, say that everything's going to be just fine. I just said the same thing as that other article. But the perception is quite different if you said the article, the headline, a different way. And in fact, read the article, and it was pretty much something like that. The facts were really a lot less startling than the headline. So I think we have to keep in mind that there are biases out there for sure. We have some, and the media has some, and that'll help us, I think, make better decisions. But keep in mind that there's definitely a negative bias, in my opinion, in media, and try to temper that with a little bit more logic when you make investment decisions.
I think that's great that you mentioned that because I think the framing of that article kind of makes you or misleads you one way or another. So it's important to be conscious of that. So maybe let's get into some of the common investing mistakes you've seen. The first is attempting to time the market. What does this mean exactly? And why might it have a negative impact on your investment returns?
Well, boy, that's for me the most common one I see. Almost every time I get a question about timing the market, almost every month. And usually, you know, clients know that I've said timing the market's really hard. So they'll say, I'm not trying to time the market, but, and then whatever follows is basically a strategy for timing the market. So I'd say that's another one like to have in the back of your mind. If you find yourself saying something like, I'm not trying to time the market, but you're probably trying to time the market. And studies have shown that people who try to time the market generally are not really good. And I would say that it's almost like gambling. When someone gambles and is successful, especially at the beginning, they tend to think that they're maybe skilled at it instead of lucky. So if you were to time the market one time and early on be successful, that would actually be, I think, pretty dangerous because then you might think you actually used skill when really it was just luck, and you might be applying a strategy of trying to be lucky, which is really not something you want to do with your retirement money. So there's been a lot of studies that show that even professionals who do nothing but this are really not that good at timing the market. And there's also the one that I see, almost every time there's a market drop, I'll see some kind of study that shows that, if you'd missed the 10 best days of the market, uh, your results can be quite a bit worse. And there's actually one here I've got some notes on, so I'll just read it to you because it's really quite startling. But I've seen numerous reports or studies like this. This was a study by the Bank of America that showed an investor who missed the S&P 500 index's 10 strongest performance days each decade, dating back to 1930, would have a total return of 28% only. Whereas if they had just stayed invested the entire time, the 28% would be 17,715%.
So a big jump.
So huge. I mean, it's so much bigger than anyone would think. And by the way, those big days tend to be when fear is at its highest. They tend to be right around, the bottoms of the market. So the days that I would say you're most likely to miss are those days. So really, really important to not try to time the market. The market tends to go up about 3 and 4 years. No, it's not like three up and one down. It doesn't work that neatly, unfortunately. But over long periods, 75% of the years approximately are positive years, and approximately a quarter of them are negative years. And those are pretty good odds if you're invested all the time. I look at it that I've got a 75% chance of being right and 25% chance of being wrong. And the vast majority of the years that I'm invested, I will be doing better than if I was not.
So I think that really helps our audience because I think everyone wants to have that in of how can I time the markets to be successful. But from what you've said, it's really difficult to do on a consistent long-term basis. Um, so yeah, I think just by being invested and kind of getting your foot in is the great or a good way to avoid being on the sidelines. So let's get to the next mistake, which is getting caught up in the fear of missing out and feeling pressure to invest in the latest market trend. How can following the herd in this way backfire?
I see often, the old thing is if your buddy's doing it and someone says, "Oh, I've been investing in this and it's worked really well," and next thing you know, you feel like you need to join in, and it's I think a natural instinct. And we've seen a lot of these things where people are jumping in as a herd. I mean, recently there was the cannabis stocks, and the theory was that Canada is leading legalizing cannabis. Therefore, I mean, there's just tons of money to make, and many investors were investing, I would say, recklessly in cannabis stocks, just jumping on anything without really, really studying what they were investing in or the price they're paying, and that can lead to problems. I saw this early in my career, technology stocks, and as I mentioned earlier, I started in 1994. And 1994, I was a young guy, and so I was pretty connected. I had never seen the internet. I'd never seen an email at that point. So just to give you an idea, and we certainly didn't have the internet or email at work at that point. But I was one who could talk to the older guys in the office, guys and girls, and tell them about this thing that was coming. And because some of my engineering friends at school had seen it, and a lot of people invested very recklessly in that dot-com bubble, and we saw how, in some cases, most of the companies never actually survived. Even the broad indices, the Nasdaq took something like 15 or 17 years. I don't have the graph in front of me right now, but the Nasdaq, if I remember correctly, peaked somewhere around March 2000, and I think before it regained that peak was something like 15 or 17 years. So, that herd mentality where we felt like we had to go in with what was a sure thing. For those that went a little bit too far on that, or who allocated too much of their portfolio to that, you would have done really bad.
So this brings us to our third mistake on our list when we're trying to chase performance, especially going for home run returns frequently. Why can this strategy be detrimental to an investor's portfolio?
If you're swinging for a home run, you're putting everything into it and using every ounce of power that you have. And most of the time, people who swing for a home run will either strike out, or they will hit the ball really hard. And they will usually strike out more often than someone who's just trying to make contact with the ball. So, a home run type investor, I think you have to understand that if you are going for a home run, you're more likely to strike out or to suffer considerable losses on that investment. And if it works, the goal is to make a significant rate of return. So you have to be aware, don't just look at the positive side of the equation, and be aware that you may lose all or a significant portion of your investment. So that's more akin to speculating than it is to investing. Now, there's nothing wrong with speculating as long as you know you're speculating, right? So most people wouldn't speculate with their entire pension plan, right? They may with a small portion of their net worth because they're ready to lose it. So I'd say if you're going for a home run, do it with the amount of money that you're okay with losing. And I would say you probably want the large part of your investments to be, swing to make contact and to get on base, where you have a much higher chance of making positive rates of return, and less chance of losing a lot of money. So yeah, I think one of the big mistakes is people are really swinging for the fences, and they do it often, and just the averages are for people that are swinging for the fences, even professional baseball players strike out much more often than they will hit the ball over the fence. So you want to be aware of that, and you want to allocate the proper amount of your net worth to that type of strategy.
Yeah, that makes sense. So you're not kind of losing out because you're still maybe investing, but not to a huge amount that it can really put you in a high risk type of um, area. Um, so it can be difficult for some investors to have the confidence in investing in securities that have not performed well recently. How can they reframe their thinking so that they can stay focused on the big picture?
Yeah, I mean that's a good point. And if 2 years ago someone had said you should invest in oil stocks, that would have been pretty difficult, right? Because they'd been doing so poorly for really quite a few years. So it took a lot of courage to say, well, I think that's just the past, and the future will be better. Again, I'm going to refer to Warren Buffett, who's one of the most, or if not the most successful investors in our time, and he always said you should buy investments as if you were doing groceries rather than buying jewelry. And he noticed that, if you're buying jewels, you'll tend to be attracted to jewelry that is more expensive. Whereas if you're in the supermarket and you could get a loaf of bread, and one loaf of bread A was X price, loaf of bread B, which was the exact same kind of bread, was double the price, you would tend to buy the one that was least expensive. So I think that you want to keep an idea of valuation in mind. So sometimes that doesn't mean buying something that's inexpensive, because oftentimes companies' profits go up every year. But if the price is relatively inexpensive relative to its profits or its cash flows, I think one has to have an idea of the price you're paying relative to the cash flow and the profits of the company. And you want to do that research. The things that I look at primarily, I'm looking at the revenue. I like revenue of my companies to be rising. I like profitability now, not hopes of profitability one day. So I much prefer companies that are profitable right now. And I always look at the cash flow, because cash flow is a way of it's a cleaner look at the profits, let's just say. And companies can show profitability legally, and not really have any profits, any cash to show for it. Whereas cash flow, if you look at cash flow and profits, the company have a really a better idea, let's say, of the profitability. So I compare those things to the price I'm paying, and what I'm looking for is good value in the price I'm paying. So I think that keep that Warren Buffett expression in mind. Invest like you're at the grocery store, not at the jewelry store, and you'll probably make better investment decisions.
Now, throughout our presentation, we've been talking about how emotions can have an impact on how we make our decisions when it comes to investing, which brings us to mistake number 4, letting ego interfere with investing decisions. What are some of the ways an investor's pride might cause them to act against their best interest?
Well, the one that comes to mind right now is anchoring, or mental accounting, and I think we all have this. I certainly do. When I buy a stock, for example, I tend to remember the price I paid, and then whenever I look at the price of the stock, I feel better if it's above that price I paid, and a little bit worse if it's below that price. And that clouds my judgment, because um, if what we've seen is the research has shown is that people who are doing that mental accounting and that anchoring, they tend to not want to sell when the stock is below that cost price, when sometimes the best thing to do is to get rid of the stock. So I try very hard, and it's really going against my instincts, to forget the price I've paid. And when I buy a stock, I I try to analyze it every day thereafter, from the price it's at today, and saying, is this a good price compared to where I think it will be in the future? And if the answer is no, or I think there's something that I think can go up more, then I should be selling that stock, whether I paid more or less for it. Now, as I've been more successful in reframing things and applying that way of thinking, I found that I'm selling losers more often than I used to.
I think that's been extremely helpful to know that anchoring, which is one of the biases that a lot of investors go through, how we can kind of avoid it if by, putting in a lot of effort to get away from it. Maybe let's revisit bias. What is it, and what sort of impact could it have on an investor's portfolio if unchecked?
When I think of confirmation bias, I always think of a friend of mine, and this goes back to 2000, year 2000 around, and we're trying to decide if Nortel was a good investment or not. To not name the company. So, I mean, it's easy now. We know the company didn't do so well, but at that point, it was a very popular subject, and the future was less clear, obviously, than it is right now when we look back on situations. So we had scheduled a time where we were going to discuss it together, and he came into the meeting. Let's say he was representing the buy Nortel, and he had taken several analysts and credible people and said these are people that have good reputations that are buying. And he took it from ironically from a list that I had seen that had about 20 uh, investors' opinions on Nortel, and I had used the same list and had basically people of equal reputations saying it was time to sell. So we were both looking for the opinions that supported our point of view. And I think that's normal. I think the best thing for us to do in any research is to seek research that confirms what you're thinking. That's going to be normal. We're going to tend to do that. And also seek research that goes against what you're thinking, or to think, if I am wrong, how am I most probably wrong? What could go wrong? What is the most likely thing to go wrong with my thesis here? I try to have artificially this bash my investment thesis day, where I say, today, I am only looking for things that could go wrong. I'm looking for research that goes against what I'm saying. I'm looking at everything with a grain of salt and trying to find reasons why I'm wrong. And I found that's really helpful. Um, then what I do is after I've done that, I already have my reasons why I wanted to invest in this particular security. Then I compare them, the two, and I found in life I try to do this kind of thing all the time. I'm a real big believer in having those plus minus lists and then looking at them objectively and seeing, once I've seen all the pluses and the minuses, where do I stand? Am I more on the plus side or on the negative side? So I think that bash my investment thesis day has been helpful, and it's made me, I'd say, in some cases, avoid some investments that I would have otherwise made, and I think that's been good in some cases. Um, in some cases, I actually still went ahead with the investment, but it gave me a better idea of what to look out for. I always like to have, two or three key risks in any investment that I'm making. What could go wrong with this? And then I kind of keep my eye open for it. And then if that develops more than I thought it would, well, I'm quicker perhaps to sell. And I've mentioned before, it's such a hard decision when's the right time to sell. So I think having those key risks in mind can be helpful.
No, I think that's extremely helpful. And it also kind of has your eyes open going into the situation so you're not surprised when those risks appear.
Yeah.
Well, thank you so much for sharing this list with us, Charles. And we're going to bring our audience into the conversation for our live Q&A in just a moment. But before we do, just a reminder that we have plenty of on-demand video, live masterclasses, and webinars to help you become a better investor. And if you've enjoyed this presentation, make sure to check out our schedule and register for upcoming events. Okay, Charles, let's hop over to our live Q&A.
All right.